Hello everyone, Alex Kim here. I want to start today with a simple number that has the power to flip the whole silver market on its head. 100. Because when silver flirts with $100 an ounce, it's not just a price, it's a headline, it's a social media spark. It's the kind of level that turns I've been thinking about buying into, I need to buy right now. And here's the part that should make you sit up straight. We are not talking about some far-off fantasy scenario. We are talking about a market that is already trading in the mid-90s, with gold sitting at extreme highs and physical silver in many places already costing you about $100 per ounce the moment you actually try to take it home. Before we go any further, if my content helps you even a little, support the channel by subscribing and drop a comment so I can see who the real supporters are. Alright, let's talk about what's actually happening, why it's happening, and what could happen next. And I'm going to do this the same way I always do. No fluffy hype, no get-rich-tomorrow nonsense, just the mechanics of the market, the psychology of buyers, and the pressure points that most people miss. Because right now, we're in a strange moment where the spot chart is screaming one thing, the physical market is whispering another thing. And the refiners are doing something that should make every serious silver buyer pay attention. And if you stick with me, I'll show you why the next move could be explosive, and also why the crowd could get trapped the very second that $100 prints on the screen. First, let me paint the scene. A dealer conversation that used to sound boring has turned into something that feels like a storm warning. People are walking into shops with the same sentence on repeat. I don't really know what I'm doing, but I want precious metals. That sentence is the smell of fear in the air. It's also the smell of momentum. And when those two mix, the market doesn't behave politely. If you're brand new and you ask, why are gold and silver going up? The easy answer is uncertainty, global conflict risks, political tension, distrust in institutions, central bank credibility problems, the feeling that the official economic numbers don't match real life. But I want to go deeper than the easy answer because uncertainty is too generic. Uncertainty is always there. The real question is why now, and why this fast? Here's my view. The move is being powered by three engines at the same time. Engine number one is the safe haven bid. When people don't trust the future, they buy things that don't require trust. That's it. Metals don't need a promise. They don't need a politician to keep their word. They don't need a bank to stay solvent. Engine number two is the industrial squeeze. Silver is not just a shiny thing. It's a metal with a job. In recent years, industrial demand has become a bigger share of total silver use, driven by electronics, solar, and electrification. Some market coverage is even describing industrial demand as roughly 60% of consumption now, which changes the entire personality of the market. And engine number three is the retail stampede. The moment everyday people feel late, they stop negotiating. They stop comparing premiums. They stop waiting for dips. They just buy what's in front of them because the emotion changes from opportunity to escape. Now, you might think those three engines are always present, and you'd be right. But what makes this moment different is that all three are hitting at the same time while the pipeline is clogged. Let's talk about that clog, because this is where the story gets spicy. A lot of you have noticed something. Some of the biggest online dealers have been pushing minimum order sizes higher. If you're used to tossing a small order into the cart, suddenly you're being told you need to spend hundreds just to check out. Most people look at that and assume it means shortage. But it can also mean something more boring and more dangerous. Operational overload. When order volume explodes, small orders become a nightmare. The labor to pick, pack, insure, and ship a tiny order can be almost the same as a large order, but the revenue is smaller. So businesses protect themselves by filtering out the smallest buyers. And here's the twist. That kind of policy can actually push people into local shops. And local shops are where you can see the panic in real time. Because in a local shop, Someone can come in and buy 1 ounce or even one single silver dime, and nobody has to build a shipping label or fight a backlog. Let's pause on that silver dime for a second, because it's one of the cleanest ways to understand what's happening. A silver dime is tiny. It's the opposite of intimidating. It's a baby step for a new buyer, and yet, at these prices, that tiny coin can cost you several dollars. That tells you two things at once. The value of silver has moved, and the value of the dollar has moved. And that's why this moment feels different to people who remember the old days, when a small piece of silver felt like loose change. That era is gone. The market has graduated into a new psychology. Now let's get into the part most people don't want to talk about, the shelf. Because demand is one thing, but visible scarcity is what turns demand into desperation. You can buy 6 figures worth of silver in a single day and the display case still looks empty. You can restock, and within hours it feels like it never happened. You can price things fairly, and one buyer comes in and clears the whole category because melt value looks like a gift in a world where everything is moving. That is not normal behavior. That is, I need to lock this down before it runs away behavior. But even in that chaos, something interesting is happening. Premiums on some high-end pieces are collapsing. This is the paradox of a fast market. When the spot price surges, premiums can compress because the spot move is doing all the work. A proof coin that used to command a big collectible markup might suddenly sell for the same as a plain bullion coin. Not because it became less special, but because the buyer's priority changed. They're not paying for sparkle, they're paying for ounces. And that brings us to the US mint pricing situation, which is one of the loudest signals in the room right now. The mint is offering a 1-ounce silver-proof coin at a price that feels wildly above spot. Let that sink in. 1 ounce of silver packaged, beautifully priced, at a level that feels almost insulting unless you interpret it as a forecast. Now, I'm not saying the mint is predicting spot will match that number. That's not how it works. They have overhead, they have marketing, they have margins, and they have a captive audience. But what I am saying is this. When official pricing gets that far ahead of spot, it quietly tells you that the people running that system do not expect the price environment to return to normal anytime soon. And here's the practical takeaway for you. If you want proof coins, because you genuinely like them, the local market can sometimes beat official pricing by a mile. The same ounce, different box, very different price. Now right here is where I'm going to drop something that can make or break a small dealer. And it can also make or break your ability to buy at the same prices. The refiner problem. If you've never run a precious metals business, you might think the flow is simple. Buy metal from customers, sell it to a refiner, get paid, repeat. But that only works when refiners behave like refiners. And right now, some refiners are behaving like bouncers at a nightclub. Not tonight, not that, not your kind. In plain language, anything alloyed, anything that isn't high purity, anything that requires extra labor to process, is getting rejected. That includes a lot of the so-called junk silver, or constitutional silver, that people love because it's small, recognizable, and historically liquid. If a shop takes in too much of that and can't move it, their cash gets trapped. And when cash gets trapped, the shop can't restock. And when the shop can't restock, the shelves get emptier. And when the shelves get emptier, the buyers panic harder. It's a feedback loop. And on top of the rejection issue, some refiners are stretching out payout timelines. Instead of paying quickly, they're pushing payments out days or even weeks. For a big player with deep pockets, that's annoying. For a small business that needs cash flow to survive, that's brutal. Think about what that means in real life. Imagine working a job and being told you'll get paid every few months. You'd feel it immediately. A shop feels it the same way, except the numbers are bigger and the stakes are higher. So when you hear refiners are refusing alloy material, don't just hear a technical detail. Hear the bigger message. The system is prioritizing efficiency over flexibility, and that pushes pressure downstream onto everyone else. Now let's zoom out and talk about the tax issue, because this is another reason demand is not evenly distributed. It's getting funneled. When a state adds a meaningful tax to bullion, people do something simple. They refuse to donate extra money for nothing. So what happens when you add a meaningful tax to a product that people buy specifically to protect themselves from money losing value? People vote with their tires. They drive. They cross borders. They turn a metals purchase into a road trip. And if the state next door doesn't have sales tax on these items, suddenly the math becomes emotional. Because nobody wants to pay an extra chunk of money to the government and receive nothing physical in return. This kind of policy doesn't just raise revenue. It reshapes the map of demand. It sends buyers to different shops. It crushes some small businesses. It overloads others. It creates pockets of scarcity, even if the national supply picture looks fine. And that's why you can see a coin shop in one area drowning in customers, while another area feels dead even though they're selling the same metal. Now let's talk about the big headline question. Are we going to hit $100 silver? I'll tell you what I think, and then I'll tell you what I fear. I think 100 is absolutely on the table in the near term. Not because I have a crystal ball, but because we've already seen days where silver can move several dollars like it's nothing. And we're close enough that a single shock headline could do it. But here's what I fear. The moment 100 prints, the market becomes a magnet for the wrong kind of money. You'll get late buyers. You'll get leverage. You'll get people who don't want ounces. They want quick profit. And that kind of money doesn't build a stable floor. It builds a tall tower that can wobble. So let me be very clear. I'm bullish on silver's long-term case, but I'm also respectful of silver's ability to slap people who get greedy. If you want proof of the long-term case, look at the structural demand picture. Total global silver demand has been hovering around the billion-ounce scale, with industrial demand pushing strong levels year after year. That matters because when a commodity has heavy industrial usage, you don't just get investor cycles, you get supply chain cycles. And supply chain cycles can be stubborn. A solar manufacturer doesn't care about your technical chart. If they need silver, they need silver. An electronics producer doesn't pause production because a candle on the chart looks overbought. They buy what they require. And that industrial anchor can keep the market tighter than people expect, especially because a large portion of silver supply is a byproduct of mining other metals. That means higher silver prices don't automatically translate into instant higher silver production. So when demand ramps and supply can't respond quickly, price becomes the balancing mechanism. Now, if silver breaks 100, everyone's going to talk about 150. But I want you to ask a smarter question. What does 100 do to behavior? Because the real move doesn't happen on the chart. It happens in the minds of buyers, dealers, and refiners. Dealers will pull inventory. Not all of them, but enough. Some will say, I'm not selling today. I'm waiting for a better price. Others will raise premiums overnight because they don't trust restock costs. Refiners will get even more selective because chaos increases risk. And buyers will do what buyers always do in a frenzy. They will accept worse deals just to get something in hand. That combination can create a situation where the spot price says one thing and the physical all-in price says something very different. So you might look at a chart and say silver is 101, but you can't actually buy it for 101 unless you're lucky. That's why the 100 level is not just psychology, it's logistics. Now let me give you a counterpoint, because I don't want you to confuse an exciting market with an easy market. There's a popular claim floating around that once 100 breaks, 150 follows within weeks. Could that happen? Yes. Is it guaranteed? Absolutely not. Silver is a smaller market than gold, and that's why it can spike. But that's also why it can drop violently when the fast money leaves. If we get a blow-off move, the correction can be brutal, even if the long-term trend remains bullish. So if you're watching this and thinking, I'll buy at any price because it's going to the moon, I want you to slow down, and I want you to decide what kind of buyer you are. Are you stacking for years, or are you trading for days? Because if you're stacking, your advantage is patience. If you're trading, your advantage is discipline. But if you blend the two, you get the worst of both worlds. Now I want to talk about the weirdest signal I'm seeing right now, and this one doesn't get enough attention: premium math. When silver was cheap, premiums felt huge. A few dollars on top of spot was a big percentage. When silver is expensive, the same premium looks small by percentage, even if the dollar amount hasn't changed much. That means buyers start to feel like they're getting a deal on premiums, even while paying record total prices. This is how the brain tricks itself. It says only $3 over spot. That's nothing. While forgetting that the spot is nearly 100 and that psychology can keep demand hot longer than people expect. Now let's bring it back to the physical reality. What can a new buyer do? One of the best things about the silver market is that you can start small. You can buy a single coin. You can buy fractional silver. You can buy a tiny piece of constitutional silver. You can build your position step by step, but you have to understand the environment. In a frenzy, the best deal might not be available. The perfect timing might not exist, and the lowest premium might not matter as much as reliability and delivery. So my advice is simple. If you're buying physical, prioritize trust and consistency over saving a couple bucks. Because in a fast market, the cheapest deal is sometimes the most fragile deal. Now let's talk about the narrative layer. Because every time metals run, the story machine wakes up. You'll hear 1,000 explanations. Some will be reasonable, some will be propaganda, some will be excuses. And the key is to understand that narratives don't move markets by themselves. Narratives move people, and people move markets. If the public believes silver is the next big thing, the public will buy. If the public believes it's too late, they'll freeze. If the public believes it's going to crash tomorrow, they'll hesitate. So part of your job as a buyer is to filter narrative from mechanism. Mechanism is supply, demand, and constraints. Narrative is the story your brain tells you while you watch the chart. Now I want to briefly touch on geopolitics, but not in a sensational way. When headlines escalate, metals can react instantly. A single announcement can push gold higher and pull silver with it. But here's the interesting part. Silver can overreact because it's part safe haven and part industrial. If fear dominates, silver can surge with gold. If recession dominates, silver can get hit because industrial demand is questioned. So silver lives in a tug of war, and that's why it's so volatile. And that volatility is exactly why 100 matters. It's a level where emotions get amplified. Now let me ask you a question, because I want you involved in this conversation. If silver hits 100 this week, what are you doing? Are you buying anyway because you believe this is the beginning of the real move? Or are you waiting for a pullback because you don't want to get caught chasing? Drop your answer in the comments and tell me what price would make you feel comfortable. And while you're down there, if you're someone who has actually done well in metals or in any hard asset strategy, share your success story in the comments too. I love highlighting real wins, and it genuinely helps other viewers keep their morale high. Now, I said earlier that the market becomes dangerous when the wrong money enters. So let's talk about how to stay sane. Here are 3 practical rules. Don't confuse speed with certainty. Don't buy because of a headline. Buy because of a plan. Don't let a single price level control your emotions, because the market loves to punish people who worship round numbers. It will break above 100, get everyone excited, then slam down $8 in 2 days just to shake out the weak hands and then climb again when nobody is watching. That's how it works. Now let me add one more layer that almost nobody discusses when they're screaming price targets: positioning and forced behavior. When a market runs this hard, It isn't only new buyers that matter. It's also margin. It's also leverage. It's also the quiet decisions that brokers and exchanges make behind the scenes. If volatility stays elevated and the price keeps ripping, margin requirements can rise. When margin requirements rise, leverage traders have to post more collateral or reduce their positions. That can create sudden air pockets on the way down, even in a bull market. And those air pockets are why silver is famous for making people feel like geniuses on Monday and fools by Friday. This is also why I watch the silver to gold ratio as a sanity check. When silver starts sprinting faster than gold, the ratio compresses, and it signals that speculation is heating up. Historically, that can be the moment where you either get the next leg higher or you get the shakeout that nobody is emotionally prepared for. And here's a historical fact that puts today's numbers in perspective. Silver's nominal peaks in 1980 and 2011 were both around the $50 zone. Adjusted for inflation, those peaks were much higher than the raw number suggests. So even if 100 feels insane, the long-term chart says insane is not a scientific argument. It's just a feeling. Now combine that with the modern industrial pull. When deficits persist, the market becomes less forgiving. This is where I want to challenge one popular assumption that higher prices automatically bring a flood of new supply. Yes, higher prices can increase recycling. People will sell old jewelry, scrap, and coins. But the same refiner bottlenecks we talked about can slow that recycling wave from becoming immediate new retail supply. Supply can show up on paper before it shows up in your hands. So when you're thinking about will 100 hold, don't only think about charts. Think about time delays, friction, and behavior changes. Those are the real levers. Now let's talk about what you can do right now today to put yourself in the best position. If you're not subscribed, fix that. Because when the market moves quickly, I drop updates fast, and the algorithm doesn't always show you unless you're subscribed. Turn on notifications because the market doesn't wait for anyone, and neither do headlines. Now let's circle back to the shop reality one last time, because this is where the rubber meets the road. When a shop tells you we bought a ton of silver yesterday, and the case still isn't full, that means demand is not theoretical. It's physical. When a shop tells you premium products are selling for normal prices, that means buyers are not shopping for collectibles. They're shopping for metal. When refiners start turning away certain categories, that means the system is prioritizing speed over flexibility. When taxes push buyers across state lines, that means demand is concentrating and the pressure becomes visible. All of that adds up to one big conclusion. This is not a normal metals market. This is a market where the smallest spark can create an outsized move. And that's exactly why you should be both excited and careful. Now another question for you, because this matters. Do you prefer stacking the popular stuff like 1-ounce government coins, or do you prefer lower premium rounds and bars? Tell me why in the comments. And if you found a strategy that works for you, share it. Again, if you've had success, whether it's metals, business, investing, anything, drop a quick success note in the comments so the community can learn from it. Now here's the final thought I want to leave you with. When the world feels unstable, people don't just buy metals, they buy clarity. And the clearest move you can make is to have a plan before the crowd forces you to improvise. If silver hits 100 and the headlines go crazy, don't let the crowd write your plan for you. Write it now, because the next phase, whether it's 110, 120, or a brutal shakeout back into the 80s, will reward the people who can think when everyone else is yelling. So do me a favor. Subscribe if you haven't, and drop a comment so I can see who's really backing this work. And remember, none of this is personal financial advice. I'm sharing educational commentary and my personal opinions to help you think through the market. You are responsible for your own decisions, your own risk, and your own timing. Take care of yourselves. I'll see you in the next one.